Your business probably made a big purchase last year. Maybe equipment, maybe a vehicle, maybe property upgrades. And you paid tax on income that essentially paid for those things twice. Most of the people running companies have no idea that the rules around this have shifted dramatically. The math on what you can actually write off in a single year is completely different now than it was 18 months ago. And if you're sitting on a business that made real money last year, this changes the conversation about what you owe. Here's what's actually happening. Recent tax law changes have created immediate expensing opportunities on major purchase categories that used to force you to spread deductions over 5, 7, or 15 years. That means your cash flow calculation, your entire tax strategy, and what you should actually buy this year, all look different. I'm going to show you exactly which purchases qualify and what the conditions are so you can stop guessing and start making decisions with clarity. Let's start with vehicles. Since this one hits most business owners first, if your company buys a vehicle and uses it more than half the time for actual business, you may be able to deduct the entire purchase price in year one, not depreciate it over 5 years. The full cost up front. This includes the purchase price itself, the delivery fees, sales tax, and the setup costs. The condition is straightforward. It has to be used primarily for business purposes and placed in service after the recent date change. The IRS does define this carefully. Any four-wheeled vehicle under 6,000 pounds can qualify if the business use threshold is met. That's most trucks, vans, and regular cars. Heavier vehicles sometimes have different rules, so that's worth confirming with a tax professional for your specific situation. Now here's where the timing matters. The math on this is quiet but serious. A business that buys a $30,000 vehicle and expenses it fully could lower its taxable income by $30,000. Depending on the company's tax bracket, that could mean $9,000 to $12,000 in tax savings in year one alone. Results vary based on your specific tax situation and bracket, but the principle doesn't change. This is a timing game. The difference between spreading a cost over 5 years and taking it all at once completely changes your cash available this year. Most people miss this because they think about the purchase price, not the tax cascade underneath it. You're not actually getting the vehicle for free. You're getting the tax benefit now instead of waiting. The second category is equipment and machinery. If your business runs on tools, manufacturing equipment, computers, machinery, production systems, or even restaurant equipment, the same rule applies. The entire cost can be written off in the year you buy it and place it into service, including installation, delivery, and training costs. A dental practice buying new imaging equipment, a restaurant installing a new kitchen system, a contracting business purchasing tools and workshop equipment, a manufacturing operation adding production machinery. All of these hit the same rule. Now, this is the part people overlook because the dollar amounts get bigger and the math becomes harder to picture. Imagine a small manufacturing operation that needs to upgrade its main equipment. The equipment costs $80,000. Delivery and installation run another $8,000. That's $98,000 total. Under the old rules, that would depreciate over 7 years, meaning the business would write off roughly $14,000 per year. Now the company can deduct all $98,000 in year one. At a 30% tax bracket, that's roughly $29,000 in tax savings compressed into 1 year instead of spread across 7. Results vary depending on the company's tax situation, but the timing advantage is real. It changes when cash actually hits the business. The trap most owners fall into is thinking about the business profit first, then the tax bill. The better way to think about it is the tax benefit first, because that determines how much cash you actually keep. Here's where it gets real. This rule changes your purchasing timeline entirely. Some business owners have held off on upgrades and equipment purchases waiting for a better year. These changes mean the better year is now the tax benefit is available today. Waiting another year actually costs you, because you lose the immediate deduction and push it into a year where you might need it less. Real estate improvements and property upgrades hit different rules, but they've opened up too. Certain improvements you make to buildings and property can now qualify for immediate 100% expensing instead of being depreciated across 5, 7, or 15-year schedules. This includes HVAC system replacements, roofing upgrades, flooring, interior modifications, and structural improvements. The mechanism behind this is something called cost segregation. A cost segregation study breaks down the components of a building or renovation and assigns each part to its actual depreciable life. Some parts have shorter lives when the tax rules align. When the tax rules align, those shorter life components can sometimes be expensed immediately, instead of capitalized. This is important because real estate typically forces you to depreciate across long timelines. A new roof traditionally depreciates over 15 years. Now, depending on the property and the study, parts of it might qualify for faster treatment. The difference between 15 years and year one is enormous in present value terms. A $100,000 roof improvement at a 30% bracket becomes $30,000 in tax benefit spread over 15 years, or roughly $2,000 annually. Immediate expensing could change that timing significantly. Results vary based on property type, structure, and individual circumstances. Most property owners don't realize their upgrades are eligible because they were trained to think long depreciation schedule. This is where it changes everything, and I'll show you why in one moment. But first, the fourth category, manufacturing and production facilities. If you're building or purchasing a building primarily used for manufacturing or production activities, there's a specific opportunity here. Under certain conditions, you may be able to write off 100% of the building cost in the first year. The conditions matter here. The building has to be used primarily for production, not storage or administration. You have to be an owner-user, meaning you own the building and operate the business inside it. You can lease it out or use it for different purposes, and there's a 10-year commitment required. You can buy it, claim the deduction, and sell it 2 years later. This is narrow, but for the businesses it applies to, the impact is substantial. A manufacturing company building a dedicated production facility could capture the full building cost as a deduction in year one. The building itself, not just the equipment inside it, for a $2 million facility, that significant tax benefit compressed into 1 year. Results vary based on the structure of the ownership and the documentation of primary use. The reason this is powerful is that buildings are typically capitalized and depreciated over 39 years. Even with cost segregation studies accelerating some components, the timeline is long. This rule shortens it to immediate, but the specificity of the rules means you absolutely need professional confirmation before planning around this. Now here's the twist. The fifth category is research and development expensing, and it works differently than the others. Domestic research and development costs can now be expensed at 100% in the year they're incurred. This applies to companies developing new products, new processes, new software, or improvements to existing products. Engineering costs, testing costs, failed experiment costs, all of it. The rule is clean. Domestic R&D work gets expensed immediately, not capitalized. On top of this, there's an R&D tax credit available, which is a separate calculation. The credit can be up to 20% of qualified research expenses above a baseline amount, so you're getting two benefits: the deduction for the expense itself, and a tax credit on top of it. Results vary based on what qualifies and how much baseline activity the company has. Most software and product companies don't realize how much of their work qualifies under this definition. They think R&D credit is only for big tech companies. It applies to anyone researching and developing improvements. A hypothetical company spending $400,000 annually on product development could deduct the full amount in the year spent if they also qualify for the R&D credit on some portion of that. The credit could add another $8,000 to $20,000 in tax reduction. But the credit rules are complex and require careful documentation. Results vary significantly based on the specific work and how it's documented. Here's what all of this reveals about how the system actually works. The fundamental shift isn't about new deductions. It's about timing. Historically, tax law forced you to spread major business expenses across many years, which matched accounting principles but compressed your cash flow. Your business earned profit, paid tax on it, and then spent money on improvements that only showed up as deductions over time. You were paying tax twice, once on the profit, then again implicitly because the deduction came later. These changes collapse that timeline. You make the purchase, you take the deduction in the same year. Your taxable income falls, your cash available in that year rises. It's the same rule, just now. Instead of next year, instead of over 7 years. The catch is documentation and timing. The IRS will scrutinize these deductions more carefully because they're valuable. You need clean records showing business use, cost, date of purchase, date placed in service. For vehicles, mileage logs and business purpose documentation matter. For equipment, purchase invoices and proof of installation. For real estate, cost segregation studies and professional appraisals. For manufacturing facilities, proof of primary use and ownership structure. Paperwork fatigue is real, but it's much cheaper than losing the deduction in an audit or missing the deadline. This is the part nobody notices. Timing creates opportunity, but only if you act while the window is open. If you need equipment next year, buying it this year saves you a year of business expense. If you've been delaying a facility upgrade, the tax benefit is available now, not later. If you're planning R&D work, the expensing opportunity applies to current year costs. This creates a decision point that most business owners don't see because they're thinking about profit, not tax sequence. Let me show you the math on this, because it's where the decision actually clarifies. A service business owner earning $200,000 in profit probably pays around $60,000 in tax, depending on structure and bracket. If that owner can identify $60,000 in qualifying equipment or vehicle purchases, they could zero out that tax bill while still owning the equipment. The equipment is an asset. The tax benefit is a reduction. Results vary, but the principle is clean. The money you were going to send to tax authorities goes to business investment instead. Here's the rhythm of what actually works. Step 1: inventory. What your business plans to purchase in the next 12 months. Vehicles, equipment, facility upgrades, R&D projects. Write it down with rough costs. Step 2: group these by category. Vehicles separate, equipment separate, real estate separate, and so on. This doesn't change the purchase decision, but it clarifies the tax opportunity. Step 3: confirm qualification with a tax professional. Don't assume each category has specific rules and limitations. Some don't apply to your situation. Some apply differently. Step 4: time the purchases. 4. Time the purchases. 4. You are crash expectation. Strategically. If you have $3,000 in tax bill coming, and you can push $3,000 in equipment purchase to this year instead of next year, you've used the rule effectively. Step 5: document everything as you go. Invoices, receipts, dates, business use, costs. This is the protection. Most owners skip steps 3 and 5, and then wonder why audits happen, or deductions get denied. The system rewards preparation. Now, the objection that comes up here is real uncertainty about rules. The IRS updates guidance. Different situations have different limits. What applies to a product company might not apply to a service company. That uncertainty feels like a reason to do nothing. But doing nothing is expensive. The cost of certainty is a consultation with a qualified professional. The cost of inaction is missing the benefit entirely. Another objection is fear of audit. These deductions are valuable, so they get attention. But the IRS doesn't penalize you for claiming deductions you qualify for if you document them properly. They deny deductions that aren't documented or don't qualify. The protection is in the paperwork, not in being conservative. Here's the mental shift that matters most. Most business owners think of taxes as something that happens after the year ends. You earn profit, you owe tax, you write a check. But the sequence actually works backwards. Your purchase decisions drive your deductible expenses. Your deductible expenses determine your taxable income. Your taxable income determines your tax bill. If you make the purchase first without thinking about the tax consequence, you're missing leverage. You already own. The new rules don't create deductions. They accelerate when they apply. Understanding the timing gives you control over when you recognize the benefit. That control is worth real money. A hypothetical manufacturing business planning a $200,000 equipment purchase in January could take the full $200,000 deduction that year. At a 30% tax bracket, that's $60,000 in tax benefit. Without this understanding, the company would buy the equipment, get annual depreciation deductions, and the tax benefit would stretch across several years. Same purchase, same equipment, different timing of the benefit. Results vary based on the specific business and tax situation. The rhythm of clarity is decide what you need, understand the tax impact, time it strategically, and document as you go. You now know which purchases qualify and what the conditions are. The logic is cleaner than most people assume. Vehicles over 50% business use, equipment and machinery expensed in year 1. Real estate improvements that qualify for immediate treatment, production facilities under specific conditions. Domestic R&D work immediately deductible. Documentation is the mechanism that protects the benefit. 3 things to hold on to. First, these rules reward planning, not luck. The business that thinks about tax sequence before buying has more control than the one that reacts after. Second, timing creates value. The difference between this year and next year is often thousands in cash flow. Third, documentation is your insurance. The paperwork takes effort. The audit takes more. The strongest move now is simple. Make an inventory of what your business will buy in the next year. Look at your tax situation and see where these rules might apply. Then confirm with a professional who can map your specific circumstances. This takes a few hours of work. The financial outcome of getting it right could be 5 figures or more. Share this with anyone running a business who's thinking about purchases or growth. The system is complex by design, but the opportunity is real once you see it.